It's that time of day in your money month when we find out what's on your mind. We are joined by our Power Portfolio Financial Advisor, Cynthia Kett, from Stewart and Kett Financial Advisors. Cynthia, thanks for joining us today.
Thank you.
Should Canadians right now be lowering their retirement expectations considering the global economic crisis and the way markets are right now?
I think it has been a bit of a wake-up call. So it's always easier to lower your expectations and then be happily surprised at the end than the other way around.
Part of that, will investors be able to make up for lost ground? Because that's, I think, the biggest fear that people have.
One hopes. History says that we should be able to expect that.
Okay, good.
Okay, let's go through some of the emails, and we have several of them coming in that we'd love for you to address. First of all, this is from Victor in Burnaby, BC, and he asks simply, when it comes to buy and hold versus timing the market, how does one determine which is better?
Well, the difficulty with market timing is that you have to have a very defined predictive process in order to tell you two things. One, when to get into a market and when to get out. And you have to be actively involved in the management of your portfolio or hire someone to do that for you. However, even the professionals have a very difficult time predicting consistently which asset class is going to outperform at any given time. So the approach that we like to take is strategic asset allocation. So we look at each client's individual situation and say what kind of asset allocation should they have. So we look at what are the funds going to be used for, how soon do they need them, what asset classes are they willing to participate in, how much risk are they going to take, what rate of return do they need to achieve in order to reach their goals. How involved do they want to be in their portfolios, and what's the cost of implementing that strategy? And then we decide, well, how much are we going to allocate to each asset class? So, for instance, cash, fixed income, and equities within ranges. Now, within each of those classes, the individual securities might change, but the overall allocations would not unless the client's situation changed dramatically. And that way, you're going to put an emphasis on those asset classes that are going to give you the highest potential return for the amount of risk you want to take, but the volatility will be mitigated by holding some of those other asset classes.
That's a very good point in terms of managing the overall portfolio, not just individual securities. We have a second email. It's primarily, it's from Paul, and he says he's primarily invested in Canadian equities, but he wants some U.S. and international exposure. His worry is about the currency, though. How do you manage for the currency fluctuations?
Well, there are two approaches that professional money managers take. One is that they actively hedge the currency risk. But there is a cost to doing that, and so they always have to be aware of the cost. So are the benefits going to be, benefits outweigh the costs of hedging that currency? The other approach that some portfolio managers take is they consider the potential foreign exchange gains and losses in their overall assessment of an investment's future return potential. And so they factor that in. As an individual investor, it's very difficult to hedge the currency on your own. So you might want to look for a mutual fund or a portfolio manager who adopts that hedging strategy if that's what you prefer. Otherwise, you can pretty much assume that they're taking the other approach.
Mark in Oakville writes in with another question, this one on the tax front. And he asks, are U.S. dividends subject to the 15% withholding tax even if they are in a TFSA or an RSP account?
The Canada-U.S. treaty, as it reads now, plans have to meet two general criteria in order to be exempt from the withholding tax. One is that the plan is for the purposes of pension, retirement, or employee benefits. Secondly, that the income has to be taxed in Canada. Well, under the RRSP, it meets both those criteria. But the tax-free savings account does not, because the tax-free savings account can be used for anything. And the whole idea is it's never going to be taxed here in Canada. So it's not exempt from that withholding tax. To add further injury to that is that because the tax-free savings account income won't be taxed, you can't claim the foreign tax credit. So if you're going to hold those kind of securities, either hold them in your RSP or in a non-registered plan.
Good advice. Number 4, from Chris. He's a father of two. He's got 10 and 11. RSP and RESPs lost over half of their values. What hope is there for the RESP to recover in time for their education, which is about 8 years or so, 8 or 9 years?
Mm-hmm. Given the magnitude of the losses, I would have to guess that all or substantially all of those holdings were invested in equities. So the thing at this point in time is to look forward and say, if I had new money to invest, would I have the same concentration in equities? And I would say that despite the fact that there is a long horizon between now and the time when withdrawals will start, you don't want to sit on the edge of your seat hoping it's going to work out. So I would suggest either allocating some portion of those investments to fixed income, or say 30% or more, and then it'll kind of make it for a less bumpy ride.
Last question for you has to do with bonds, and this comes from Mark. Which type should I be buying? First of all, is now a good time to buy bonds? And then, of course, across the spectrum, corporate, government, real return.
Okay, is it a good time to buy bonds? I believe that there's always a place for bonds or fixed income in any portfolio. It adds stability to a portfolio. They're not exciting or sexy always, but that's not their job. Their job is to provide some ballast. As to which kind to buy, it depends on your risk profile. Again, it depends on what you need the money for and when you need it and all that kind of thing in terms of how safe or how risky you go. Government bonds are the safest. Corporate bonds, we're seeing some good rates of return on that right now. Real return bonds, if we think that inflation is in the making, then that's the way to go.
Cynthia, thank you very much for coming in.
Thank you.
Cynthia Kett from Stewart and Kett Financial Advisors. If you want to get your question answered by one of our guests, send them in to your money month at bnn.ca.